It's tax time again, and for Aussie crypto investors, your digital assets are set to come under scrutiny. In this video, I'll take you through how crypto assets will be assessed by the ATO for this financial year. Now, first and foremost, the Taxation Office requires Aussies to maintain a record of all crypto transactions. The word all is indeed fully capitalised in the official documentation available on the Australian Taxation Office website. For reference, all documents of the ATO mention cryptocurrencies as crypto assets. This means that cryptos, including non-fungible tokens or NFTs, attract capital gains taxes. Complications can arise when the ATO also suggests that the personal use of crypto assets with no regard for investments is exempt from capital gains tax. Here, the holder must note that this treatment requires holding the asset for only a short period, over which the holder uses the cryptocurrency to purchase any item for personal use. For example, if any merchant accepts cryptos as payment, the payer might opt to make such payment by briefly converting fiat currency into cryptos. No capital gains tax is levied in such cases. Cryptos held for investment purposes, which is mainly decided by the duration for which the asset is actually held, necessarily attract the levy of capital gains tax. Tax implications on crypto assets in Australia are actually reasonably straightforward. When a holder disposes of any crypto asset, any gain must be included in the tax return. And the math is pretty simple. You bought a crypto asset, say Ether, using 100 Aussie dollars. When you sell it, partly or completely, and convert it into a fiat currency or any other asset like Dogecoin and then book gains, the transaction attracts capital gains tax. If the transaction is made in any other currency, for example the US dollar, at the time of acquisition or disposal, it must first be converted back into Aussie dollars before arriving at any calculation. Tax liability arises when the transaction is made, regardless of whether the held crypto asset subsequently loses value. For example, if your Bitcoin investment is presently losing its value, capital gains tax will still be applicable if any gains were booked on any previous transaction. The ATO permits net capital losses to be deducted from capital gains accruing in a later year. However, such losses on cryptos cannot be adjusted against income and gains from non-crypto sources. The taxation of crypto and digital assets continues to be a heated debate, especially considering many investors turn to crypto in an attempt to overcome the rising cost of living and things such as the housing crisis. Regardless, the ATO is hawkish on digital assets this year, so failing to declare could be a cause for great concern for yourself. Do you think crypto gains should be taxed at all? Let us know in the comments below and make sure to like and share the video. And for more content, you can subscribe to the channel and press the bell icon. I'm James, reporting for Kalkine.